Which index is better, the Dow or the S&P 500? That's what we're going to talk about today. First, thank you for being here. I'm Austin. I'm a co-owner of cloudmusicsuite.com and of course, a stock market investor. So go ahead and hit that subscribe button. Thank you so much for doing that. As a thank you, I'm going to show you a picture of both my cats, okay? Millie is the gray one and Luna is the brownish one. They said thank you for subscribing. We're around 120 subscribers. Thank you so much to everyone who has taken a moment to subscribe. Okay, let's get into this. We have a head-to-head between the Dow 30 and the S&P 500. If you haven't heard of these things before, these are stock indexes or indices. They hold a bunch of different stocks inside of them. The Dow holds 30 stocks inside of it. That's why it's called the Dow 30. And then the S&P 500 holds 500 companies in it. That's why it's called the S&P 500. You can invest into these indexes through something called an index fund. For the Dow, you can find something called DIA. If you look up that on the stock brokerage that you have, that's the Dow Jones Industrial Average ETF. And then you can look up SPY or VOO. Vanguard has an S&P 500 index fund, and then SPY is also a Vanguard Spider index fund. They track the exact same thing. Don't buy both of them if you're going to buy them, just buy one. They track the literal exact same index, so just choose which one has the lowest expense ratio that you feel the most comfortable with. Anyway, so now that you know how you would find them on the stock market, just know that some people believe that index fund investing is the best way of investing of all time. A lot of people hold this belief, all right? If you hold that belief, now the next question is, what index should I buy? What index fund is the most important index fund or the best index fund to buy? Let's compare Dow 30, I'm going to use DIA specifically, to SPY. First of all, let's just do the performance. Past performance does not mean that future performance is going to equal this, but it's important to look at past performance so we can see what it's looking like since inception. So since the DIA, which is the Dow Jones Industrial Average ETF, was created, there's been an 8.39% return on assets. So you would get an 8.39% every single year, year in and year out. Does that mean that each year you get an 8.39%? No, it means some years you might get a 17%, some years you might get negative 2%, some years you might get 20%, some years you might get negative 10%. But on average, it has averaged out to an 8.39%. If we compare that to the SPY, which is the S&P 500 index, 9.84%. Okay, so that's about a 1% plus difference between the Dow and the S&P 500. That right there is the first hint that I would say the S&P 500 is winning so far in terms of past performance. Does that mean the future performance is going to be the same? No, not necessarily, but a 1% difference is a big deal as it relates to compounding over time. So something to consider there, 9.84. So I'd say S&P is in the lead so far. Next, I want to talk about the holdings and how these things get their holding weights. So the Dow holdings top 10, I'm gonna just read them off and I'm gonna put them on the screen there. United Health Group is number one at a 10% weight of the Dow. 10% is United Health Group? That's ridiculous. Goldman Sachs Group, huge bank, 6.41%. Home Depot, everyone knows Home Depot, 5.75. That's the top three. Not my favorite top three I've ever seen in my life in terms of an index fund. United Health, Goldman Sachs, and Home Depot. Next after that is McDonald's Corporation. Come on now. Microsoft is after that. Okay, respectable. Amgen, okay. Visa, respectable. Caterpillar, I like that company as well. Boeing Company, yeah, no way. And then Honeywell, a great industrial company. Okay, so the top 10 for the Dow, which by the way, that's a third of all the companies that are in the Dow because the Dow only has 30 stocks in it. So top 10, I could definitely do without a few of those stocks, specifically Boeing Company, McDonald's, United Health Group. I wouldn't ever personally buy those companies. That said, that's not the goal here. The goal is to average out your returns from the index, okay? How these things are weighted, meaning the percentage allocation into each one of these stocks, is the dumbest thing I've ever heard in my life for the Dow. The Dow weights are based on share price, not market cap, but share price. So you could be in the Dow and you could do a reverse split to make your stock price double as valuable, and you could double the weight that the Dow would have to hold based on their rules for weighting. So since United Health Group has the highest share price, not the highest market cap, but the highest share price, that means they get the highest weight. Goldman Sachs has the second highest share price. That's why they're at 6.41% weight. And then Home Depot after that has the third highest share price. Share price is so irrelevant. It's about market cap divided by shares outstanding. You change the shares outstanding, you're going to change the price of the company in terms of share price. So stupid, not about it at all. I do not like it. Okay, let's go look at SPY, which is the S&P 500 index fund, or you can look at VOO. It's the exact same thing. So, index top 10 holdings: Apple, biggest company in the world; Microsoft, second biggest company in the world; Amazon, third biggest company in the world; Nvidia, fourth biggest company in the world; Alphabet, which is the Google parent company, fifth biggest company in the world, etc. So what I'm getting at here is the weights are determined by market cap for the S&P 500, which is not flawless. I don't think that's flawless, but I think it's way better than share price being the thing that determines the weight. So we have the biggest companies in the world. They don't just get to the biggest companies in the world for no reason. By the way, United Health Group is still in there at the 9th biggest position in the S&P 500. This, of course, might change over time as market caps change and shift, so they might get knocked out of that top 10. But let me just finish out the rest of the top 10. Berkshire Hathaway, and then we have Alphabet Class C, which is the other side of Google. So they have Class A shares, Class C shares. Some have more voting power than others. Tesla, and then Meta, which is the Facebook parent company. That's a really, really good top 10. Yes, there's a lot of big tech in there, but we have Berkshire Hathaway, huge asset manager. We've got a chip maker in there with Nvidia, and we've got 3 huge big tech companies along with Alphabet, and then the tech/automaker Tesla, healthcare group United Healthcare, and then another tech company, Meta. So it is a little worrisome in terms of the weights being so heavily toward big tech. But big tech are the biggest companies in the world, and they've commanded those valuations and those market caps for a reason. It's not like they have zero revenue and they're the top company in the world. It's because their revenues are ridiculous and their profits are ridiculous, okay? Something to think about. Okay, next, one of the most important things as it relates to these two indexes. The Dow, the way the stocks are picked, is literally just subjective opinions from Wall Street Journal editors. That's not my preferred way of choosing what stocks go into an index, right? S&P 500, on the other hand, there have to be actual real criteria. So you have to meet this criteria, and then you are selected by the index committee after you reach this criteria. So there's 6 main points. You have to be a US company. Market cap has to be at least 8.2 billion. The shares must be highly liquid, meaning a lot of trading volume is going on in these shares. There's basically a hot stock that's not a nobody company. At least 50% of the shares outstanding must be available for public trading, really important. It must report positive earnings in the most recent quarter in order to have the S&P 500 inclusion. So you have to be profitable. Also, last thing about profitability, some of its earnings in the previous 4 quarters must be positive. That's really important too. Companies that aren't profitable are typically seen as way riskier because they either have to take on more debt to continue operations, or they have to dilute shareholder equity in order to continue operations, or worst case, go bankrupt, which would be horrible for you as an investor, obviously. So really important that they have to be a profitable company. I bet the Dow inclusion, you have to be profitable as well, but since there's no like specific criteria that's public to the investing community, it makes me nervous. Like they're just choosing on a whim, like, oh, United Healthcare should definitely be in this index. Oh, Home Depot should definitely be in this index. The Dow Chemical Company should definitely be in this index. Why should the Dow Chemical Company be in the Dow 30? Like, what's the purpose? Is it just for the meme? Is it because you really, really think that this company is one of the greatest companies in the world? I think they should choose, like, honestly, what are the 30 greatest companies in the world? I don't know if they're actually thinking about that question right there as it relates to the Dow 30. If that was true, Costco has got to be in the Dow 30. I think it's one of the best run companies in the whole world, Costco. Okay, that's not in the Dow 30 at all. I don't think they're actually looking and saying, what are the 30 best run companies in the world? And as a result, I just don't feel good about such a small number of companies being subjectively selected by the Wall Street Journal editors. And then inside of that, they have the weights by share price. Like, bro, what are we doing? What are we doing? So I have a clear pick for the S&P 500. I think you should absolutely go with the S&P. The historical performance of the S&P has outdone the Dow, and I do believe it's going to continue to outdo the Dow in the future. The S&P, you are way more diversified, and you don't have to worry so much about all the individual holdings because there's so many of them, and they're all profitable companies. They're all highly liquid. They're all from the US. They all have a market cap of at least 8.2 billion. They all have positive earnings. Okay. If a company starts to have bad earnings, bad profitability, unfortunate times for this company, terribly run company, guess what? They get dropped out of the S&P 500 and someone else gets included back into the S&P 500. It's really just rigged in your favor to pick the cream of the crop for you to own the S&P 500, 500 of the greatest companies in the United States of America. I think the S&P 500 is a way better investment than the Dow. I think it's going to be a way better investment moving forward than the Dow. The Dow is seen as like this inflation-proof value play. I don't agree. I don't think it's what it once was. Now that we have the S&P 500 with as many funds and as low of expense ratios as we have for the S&P 500, I think it's a no-brainer. Buy the S&P over the Dow 100 times out of 100. That's just my opinion. Do what you want to do. Make your own investment decisions. If you made it this far, thanks for being here. I appreciate you so much. Hit that subscribe button. You clearly enjoyed it if you made it this far. Thanks so much, and have a good day.